What's up, investors? It's the Russian dude. Let's talk about right now whether the US economy is on the edge of a potential correction or in worst case scenario a recession. Because if you do remember my Friday's video, we were talking about the Federal Reserve saying, whatever guys, we're no longer gonna wait until inflation hits our own target of 2%, we're gonna start cutting rates as soon as possible. And then, literally one day before making that statement, they mentioned that if you cut rates way too early, this might reaccelerate the inflation, undoing all the process of the last couple of years we achieved. So yeah, it's a mess. Let's talk about all of this right now. And specifically in today's video we're gonna discuss new material. First of all, we begin with the most recent ISM PMI report, which came at 48.5 and previously it was 48.7, and ISM Services PMI came at 48.8 while previously it was 53.8. And if you remember, if you know guys, anything below 50 means that there is a slowdown in the economic activity in this particular sector. So basically, yeah, services dropping from almost 54 down to 48.8 in just from one report to another. This is a huge decline, and one of the things about potential recessions is when exactly the economical activity slows down. Well, there you have it. At the same time, manufacturing PMI is also below 50 for the last 19 out of 20 reports, almost every single one of them as you can see, and the last time it happened exactly like this was always before any major recessions. Besides that, the growth of the actual wages slowed down while the unemployment increased a little bit. Yes, this is what the Federal Reserve wants to see before they start cutting rates, but they also need to wait until inflation slows down to their target of 2%. They cannot just see one thing happening and other things still being above their target, and they're like, okay, whatever, good enough, let's start cutting rates. No, if you do it way too early, once again you can undo the entire process of several years. And yet, another thing, whenever the S&P 500 index, it was almost always correlating with the PMI data, but not until spring 2024. After this, the correlation became absolutely random, no correlation basically whatsoever. And also, historically, this was one of the also very first signs before at least potential upcoming correction, which might, according to historic data, come approximately in the fall of 2024. And then we also talked about the most recent CPI inflation report in our last Friday video, but the reaction of the S&P 500 or just in general the stock market was completely the opposite from what people expected, because they wanted to see the decrease in inflation, and this is supposedly a good sign, because it means that the cuts of rates will start to happen in the near future, and this is exactly what the majority of market participants they want to see happening. For them, this is a very good sign. And so, according to this graph, as you can see, futures prices for the S&P 500 index, in fact, they lost 1% of its value just because of the most recent CPI data. The question is, why there is a negative reaction to a positive data? But if you think about it, the real answer is not that complicated. All we need to do is just take a look at this heat map, which shows the performance of each company within the S&P 500 index. The bigger the square, the bigger the weight of each particular company within the index itself. And the phenomena we are seeing happened for the very first time since 1978. Once again, whenever the data is good, but the reaction is negative. But if you take a look deeper, it was only the performance of the top 10 companies, or like magnificent 7 companies, how many people call them? Microsoft, Apple, Nvidia, Microsoft, Tesla, I mean, well, you know those companies, Google, right? So it is these companies which performed negatively based on this positive data, while the rest of the companies on the S&P 500 index and just in general the rest of the stock market, in fact, all of them were in the green. Specifically, a Russell 2000 index added 3% based on the most recent CPI data, while once again the S&P 500 lost 1%. This is also exactly the very same thing we were talking about in the last several videos, that the performance of the entire S&P 500 index right now is dictated by just a handful of companies, of those magnificent 7. So you might have 493 companies being deep in the green, but just 7 massive companies which represent 20 to 30% of the index itself, as long as they behave in the red zone. Well, as you can see, the index will be in the red as well. Right here is another pretty interesting graph which is showing how these top companies are performing, and as you can see, Nvidia, for example, is absolutely crazy. And the next graph shows the correlation between these top companies and the rest of the S&P 500 index, which, as you can see, the correlation right now is absolutely negative. Whenever things are good, whenever the rest of the companies go up, the top 10 companies go down, and then exactly though, well, that's pretty much the negative correlation, once again as reflected by this graph. And the very last time this correlation was so low or even negative, guess when it happened? During the dot-com bubble crash. We also been talking about this problem in my previous videos, guys, so you already know all these things. If you are new to this channel, I'll just summarize it briefly. Basically, yes, don't rely that the S&P 500 is in the green, it is growing, it is updating its all-time high numbers. In reality, it's only 10 companies which are responsible for the performance, while the rest, 95% of the index, could have been deep in the red. Well, now, as you can see, tables turned, now you can see the real picture. And since the US economy is closely related to the performance of the stock market, well, as soon as the stock market corrects itself by 10% or more, well, the economy will feel the effects as well. This goes like out of the question. And we already have potentially the very first consequences of this potential decline, and this might even become even worse in the near future. For example, the number of bankruptcy filings since the beginning of this year reached to 346. This is the biggest number since 2010, with only one exception. Right now, this number of 346 bankruptcies, it only happened in the first 7 months of this year. So we still have 5 more months to go, and we already seeing the numbers the biggest in the last 14 years. So as you can see, it can and most likely will get worse. Well, there you have it, guys. Thank you so much for watching. Please like this video, subscribe to my channel if this was interesting, informative, or both. See you tomorrow.